Hi friends, this is Nishant and it's a Sunday afternoon, so I thought of having a word with you. And I was actually going through some messages and all that, and I could see an issue. I could see an issue which is a big disconnect, in terms of understanding of the instrument and the capital size, which is getting blamed on analysis. What I mean to say here is, I'm basically talking about that why F&O is ultra difficult, you know, and it is not about analysis. This is what I'm going to talk about. It is not about analysis. It is actually about understanding the intricacy of the instrument that you are using vis-a-vis the capital that you have, that you are risking. When you do cash segment trading. Now, before I'm doing all this, I'll assume that everybody has understanding of analysis, which is technical analysis, that everybody can see charts, read charts, different time frames. People have a fair idea of how to go about option chain, all that stuff. What is called selling, what is called buying, what is put selling, what is put buying. How does what does it represent? Basics of futures. I am assuming that all that part is clear. Now, why I'm saying that F&O is ultra difficult and why, people lose money in there, and then it gets blamed on analysis, whereas analysis is a very small role to play in the failure. As I said, that the biggest cause is, the disconnect between the instrument and the capital, and the understanding of the instrument itself. I'll come on to that. When you do cash segment trading, it is pretty linear, right? So let's say you buy something. For example, you have 20 lakh rupees. You buy a stock worth 20 lakhs. Example. Then a 1% move against you will erode 1% of your capital. A 5% move against you will erode 5% of your capital. Or, if you have 20 lakh rupees and you buy 4 stocks, 5 lakh each, and every stock, in that case, then let's say you have 5 lakh rupees, you bought 5 lakh rupees worth of stock. Even if you give, let's say a 10% possibility against you, so that is 50,000 rupees in one trade, correct? And you have taken 4 trades. So 2 lakh rupees you are taking as a loss in 4 trades. Your capital is 20 lakhs. So 10% you are risking. But then here you are diversifying also, because if all the 4 trades are going wrong, then something is wrong with your analysis. But generally it's not the case, right? But if you are buying one stock, let's say worth 20 lakh rupees, the calculation is pretty straightforward. And let me tell you something. When we think about cash trading, broad understanding, broad analysis of stuff is generally enough. Even if your timing is a little bit off, it's forgiven by the market. What I'm trying to say here is, let's say you have an uptrend on monthly chart, and you bought somewhere because it's a good uptrend, and you think that it will go up, and price corrects for a couple of months to make a higher low, and eventually it goes up. You're forgiven, right? It's okay. Sometimes, let's say, you within a monthly uptrend and monthly price is going up, your weekly is also going up, and your daily enters into a correction, and you enter there thinking that within a running move of monthly and weekly, I am entering a correction of daily, and that correction deepens a bit, and weekly gets into consolidation while monthly is still moving up. Then eventually daily makes a higher low base, and whatever it is, a W structure, and it goes up, you're forgiven. And this is what happens because most of the cash traders, they do not nitpick, they do not go into 1 minute move, 5 minute, and they shouldn't. Good sized money, if you are if you do a trade which makes you 10%, 15%, 20%, 30% or more. When I say more, when I say, it's compounding over many years, and now your money has doubled or tripled, that's a long term investment, that's a very long term trade, that where you are playing the monthly trend itself. But if even if you make 10%, 15% on your money by holding for a few days or weeks, it's okay. It's very good money. So what I'm trying to say here is that even if your timing is a bit off, even if after your entry price goes against you, stays against you for some time, makes a new base, then goes up, you're forgiven. But when it comes to FNO, first, within FNO, you have F and you have O. The F part is still linear. I'll come to that. The O is devastating. Coming on to the O part, which is options. So option selling, option buying, but majority of people, because they have less money, they resort to options buying. I'm not saying option buying does not work, but it needs a great degree of timing skills. It's having a broad understanding about direction does not work. You might be thinking that this will go up, but before going up, if it enters into a 2 hour, 3 hour correction, you are finished. So in cash trading, you were even forgiven if your timing was off on a monthly chart. For 3 months, price was consolidating. It's okay. In options buying, even three candles of 15-minute consolidating can erode you. So you have to be very exact there, which is difficult because you might have it, you might get it 1 day, 2 day, 3 day, 4 day, 5 days. Then 1 day, all gone. Everything is gone. It happens because of greed, because of bigger position size, and sometimes choppiness of the market, which is a feature. Now, the thing is that options, I'm not talking about option selling here because, then we get into strategies, it's a different ball game. I'm talking about options. When majority of people hear options, they think about options buying. Options buying is not a linear game. You can have an uptrend in monthly chart, weekly chart, daily chart, in hourly chart. Every chart is uptrend going up. Last 2 hours went up, and now you are thinking that this is going up, let me buy a call. If just 1 hour corrects, consolidates, things can get so volatile on 5 minute, 15 minute that your capital will fluctuate like this. So either you take a position which is irrelevant, which is meaningless, which is non-significant, then it is okay. But still, decay is a factor here, right? It's not just about timing, it's about decay also. So you are fighting two beasts here. One beast that you are fighting is the timing. Options buying is not something where you enter and you can hold, it's not a buy and hold instrument. Unless and until it is part of some big hedging plan. But if options buying is the main trade, the primary trade, then it's not a buy and hold instrument. So you have to be very exact about the timing part. It moves and you exit, you enter when it starts moving, and you exit within the move. You don't wait much. That's why majority of options buying happens in scalping format. And decay is there. People who trade zero DTE, which means 0 day to expiry day options. You must have seen many times that even when price is going up, options is coming down. So, option is here, price is here, price goes up, but option doesn't go that much up, it goes up like this. Price comes down, but still higher from the previous option is here, right? So, decay is also a part. Then IV, implied volatility. No, as I said, not linear. Futures is still somehow linear in terms of that there is no decay. Yes, there is a timeline because futures have expiries, unlike cash. Cash segment does not have an expiry. So in cash segment, you can, if you can freely hold something for 2 months, 3 months, 4 months, 5 months. In futures, yes, you can roll over, but rolling over means just killing this position and starting new, right? So you are still booking a loss before getting onto a new position. So it's a new position. But futures, you are just bound by time. If you think that, let's say tomorrow or day after tomorrow or day after tomorrow, if you think that a move can happen within a stipulated timeline, then it is much better instrument to play than options because there is no decay. One, there are not many things to follow. You don't have to see the, you don't have to see the IV, you don't have to see the delta because futures is linear. The only thing about futures trading, which can go wrong is position sizing. I'll tell you how. For example, you have 20 lakh rupees, okay? Now, one alternative is that you buy a stock worth 20 lakh rupees. So then your returns are linear. Options mein issue kya hota hai? People buy options worth 20 lakhs. Which can go zero the same day, which index will just move, even less than 1%. Your option can go 50% against you. So in options trading, you can lose 20 lakhs in a day. In cash trading, it is very difficult to lose 20 lakhs in a day. In futures trading also, it is very difficult because, it's very difficult. So let's say you have 20 lakhs. One idea is to, buy cash segment and returns are linear. Now, either you buy 20 lakh worth of stock, or you, let's say, buy 10 lakh, or you buy 5 lakh. It's up to you. Futures, let's say the stock is 1,000 rupees and lot size is 1,000. Okay. So a lot size is 1,000 shares and stock's price is 1,000 rupees. So the contract value of one lot is 10 lakh rupees. Let's say the margin money to buy one lot is 2 lakh rupees. So when you buy one lot with 2 lakh rupees, effectively you are buying a position size of 10 lakh rupees. Now a 1% move, let's say a 10% move against you would be minus 1 lakh. A 10% move against you would be minus 1 lakh because position size, the contract value is 10 lakh. So a 10% move against you is 1 lakh, which is 5% of your total capital. Okay? Right? Total capital is 20 lakhs, but you just bought one lot. So a 10% move against you is a 5% erosion in your total capital, but 50% erosion in your margin because margin you paid 2 lakhs. What is the equivalent of buying 20 lakh worth of stock? If you, in cash segment, if you buy 20 lakhs of stock, what is the equivalent here? The equivalent here is to buy 2 lots. If you buy 2 lots, your P&L, your calculations would be similar to as if you bought 20 lakh rupees worth of stock. Because one lot here has a contract value of 10 lakhs, 2 lots would have contract value of 20 lakhs. And if you buy 20 lakh worth of stock or you buy 20 lakh worth of contract value, your P&L would be similar. In my view, if you ask me, if you have good capital, let's say you have 20 lakhs, 25 lakhs, 30 lakhs, options is something that you can easily avoid. Even though cash trading can be very, very fruitful, can be very, very rewarding. But if you still want to, graduate organically, I think the organic graduation from cash trading is not options trading. It is futures trading. But given you have good capital, if you have 2 lakh, 3 lakh rupees, if you can only buy one lot, there is no point, na? Because then where is the risk management? You can only manage risk if you have, if you can afford 10 lots, but you are buying one lot. So you cannot manage risk if your entire capital is just one lot worth of a futures contract. Now, as I said that, you have 20 lakh rupees and yes, timing is required much more than the cash segment. But there is no decay, as I said, and there is more, it's, yes, your ROE, your ROI is can take a boost, can take a hit, but if you manage it intelligently, you can use it to your favor. I'm not talking about stuff like buy a future, sell a call. I'm not going into that. This video is not about that. This video is about understanding the instrument and how to use it effectively. So if you have 20 lakh rupees and you buy stock worth 20 lakh rupees, 1000 rupees stock price, and one lot in futures is 1000 shares, example, and 2 lakh rupees is the margin money. Then one lot contract value is 10 lakh rupees. So you are giving 2 lakh rupees to buy 10 lakh rupees worth of contract. So you are leveraged 1:5. And if you buy just 2 lots of 4 lakh rupees, giving margin money, you are basically equivalent to somebody who has bought 20 lakh rupees of shares. Correct? The issue is, where do people fail in futures? They fail in futures because they think they have 20 lakhs. And one lot's margin is 2 lakh rupees. So they think that, oh, okay, I can buy 10 lots. And they buy 10 lots. One lot's contract value is 10 lakh rupees. 10 lot contract value is 1 crore. And as you know that we were leveraged 1:5. So they are paying 20 lakh rupees as margin, but their P&L is happening at 1 crore contract value. So even, let's say, a 5% move against them, if they buy 10 lots and 5% move in a stock is nothing, I mean, if you are taking a trade on daily chart, I'm not doing intraday here, okay? I'm talking about taking a trade that, okay, my monthly is coming out of a consolidation and I can see a monthly swing happening here. My weekly is also coming out of a consolidation. My daily chart, had been in an uptrend making higher highs and higher lows. It came down to make a higher low. Now it is turning up. So I'm entering here with the stop loss. Things have to be planned, right? But now I'm buying 10 lots because I can afford 10 lots because one lot is 2 lakh rupees and 10 lots is 20 lakhs and I have 20 lakhs. So I buy 10 lots. Now one lot's contract value is 10 lakhs. So 10 lots contract value is 1 crore. Now if stock goes 5% against me, and 5% is nothing in a positional trade, that 5% against me is minus 5 lakhs. Correct? Remember my capital. This 5% minus 5 lakhs on 1 crore because the contract value is not, but your capital is 20 lakhs. You are minus 5 lakhs on a capital of 20 lakhs. It's a 25% destruction against you. So just a 5% move against you eroded 25% of your account. Similarly, on an upside, a 5% move in your favor can give you 25% ROI also. But then that's not worth it, na? That's not worth it. And you will see that, this ratio, that when your total contract value exceeds 20 lakhs, because that's your capital size, when your contract value exceeds 20 lakhs, which means more than 2 lots, 2 lots contract value was 20 lakhs. So more than 2 lots, it increases the contract value, is higher than 20 lakhs. Now a lesser percentage move in the stock will be a bigger percentage move in your profit and loss in terms of ROI. So let's say you have 5 lots, example, which means 5 lots means contract value is 50 lakhs. Though you have just given 10 lakhs because leverage is 5 times, 50 lakhs. Now a 5% move against you in 50 lakhs is 2.5 lakh rupees. That 2.5 lakh rupees, that 5% move against you, 2.5 lakhs, is still 10% of your total capital. You're getting the point? So, because the contract value was 50 lakhs. But if your total contract value is lesser than your total account size, so for example, I buy 1 lot. 1 lot's contract value is 10 lakhs. Okay? My account is 20 lakhs. But I am giving just 2 lakhs to buy 1 lot. Now, 10% move against me. 10% is 1 lakh rupees because I bought 1 lot. 10% move against me is 1 lakh, which is basically 5% of my account size. So this is the balance. Optimal, you have to think in terms of your account size and contract value. Most people miss this metric. They think, acha, it's going up, let me buy. Because I can afford this many lots, let's buy this many lots. In futures, the biggest number to think of is the contract size as well as the account size. When the total contract value is at par with the account size, then you see that it starts behaving like a cash position because it's linear now. The P&L would be same as if you are holding a stock worth your account size. The moment your contract value gets higher than your account size, then a lesser percentage move in the position would bring a bigger percentage move in your ROE. When your contract value is lesser than your account size, then even a bigger percentage move in the stock will produce lesser percentage move in your ROI against you or for you, as I just calculated. Then you will say, but then what's the point? If I have 20 lakh rupees, if I take 1 lot by giving 2 lakh rupees, contract value of 10 lakhs, and stock goes 5% in my favor and I sell, then a 5% move would mean 50,000 rupees because the contract value is 10 lakhs. So 10% move is 1 lakh, 5% move is 50,000. But that 50,000, that 5% move is 2.5% ROI because 50,000 against my 20 lakh capital. But don't look at it like that. Look at it like that you made 50,000 rupees by employing 2 lakh rupees. That's a 25% move. So, the advantage, you should not see futures as if to that, okay, my account size is 20 lakhs, 1 lot is 2 lakh rupees, I'll buy 10 lots. Because as I said, that buying 10 lots means having a contract value of 1 crore. Any percentage move would be huge in terms of your, total capital return, negative or positive. So optimal is that your position size should be equivalent to your total, the contract value should be equivalent to your account value, which in this case is 2 lots. So if you buy just 2 lots here, now your P&L would be similar to as if you have bought stock worth 20 lakhs. You can have similar sort of breathing space and all that. But you will say, then what's the point? The point is you are just using 4 lakh rupees to do that. That's the point. Right? So the advantage of futures is not in terms of how much more return you can have in terms of multiplication, The advantage is capital efficiency. That I have 20 lakhs, I can buy 20 lakh worth of this stock, correct? But I am not doing that. I'm just buying 20 lakh worth of contract value to have the similar P&L of 20 lakh, but I'm using 4 lakhs. If you think about futures in these terms, then things get little meaningful, and then it's more or less like cash trading, but more capital efficient. If you try to think of futures trading as, oh, I'll put in this money and I'll earn in multiples, then again it becomes a destructive instrument. It remains constructive as long as the position size is in check and you are continuously aware of contract value, correct, and account value. ठीक है, चलो, you have 20 lakh rupees, one lot is 2 lakh, so you can buy 10 lots. Don't buy 10. Even if you want to go above 20 lakh contract value, max to max buy 5, but then be quick to cut it, if things start going against you. I have in cash positions, I am okay scaling up also. So I bought some quantity here, price goes up, makes a new base, I add the quantity there. Futures, since again they have an expiry, right? So I don't do it in futures. I don't do pyramiding in futures. I'm talking about, it's not right or wrong. My style is either, by for example, I can buy 20 lots, but I think that I will not go to 20. My median is 10, so I'll go to 10. So either I do it this way, that I start with 2. When the trade is developing, it's making a base, and it's still maintaining the cluster, and higher time frames are good. When there are new evidences coming, I might increase 2 to 5, 5 to 8, 8 to 10. That's all. Either that, or if in some cases when stock is like, it is moving just now with a very, very tight stop loss, if I'm getting that on the chart, I might enter with 20. I will never scale to 20, never. I might enter with 20, and with just a little move, I would exit 10, because the position size I thought was 10. That move can be in my favor or against me. Those extra 10, they have to be clipped off immediately, because that's not my comfortable position size. I'm using that just as a steroid. But my general rule is that, if you want to be comfortable doing futures trading for the long term, don't exceed too much over your account size in terms of contract value. So if your account size is 20 lakhs, one lot is 2 lakhs margin, contract value is 10 lakhs, 2 lots is your optimum position. Chalo, theek hai. Though you can afford 10 lots, but don't go above 5. And 5 also, that if you think it's immediately moving, keep a tight stop loss of 3 lots, because those are 3 lots are extra. If you do this, if you do futures trading like cash trading with the similar risk management of cash trading, because in cash trading, max to max with 20 lakhs, you could buy 20 lakhs worth of stock. So your P&L would be according to max to max, your loss or profit would be according to 20 lakhs. Do the same thing here. But you will say, what's the point? What's the benefit then? Wouldn't I buy 20 lakhs of stock? The benefit is that you are using 4 lakh. The benefit is in capital efficiency. Don't seek benefits in multiplying returns. See benefit in saving capital and using that capital somewhere else. So this is what I wanted to talk about, that how to have mental models of cash trading, futures trading. Options trading is out of question unless and until it's part of a bigger plan, that you are doing some option selling here, and then you're doing hedging. Otherwise, having money and buying options of that money, that's not the point. So I hope it would add some value in your understanding, and we'll keep talking. Yeah, best of luck.